The views expressed on this podcast are those of the participants, not of Reuters News.
Japanese acquirers are out hunting for targets. Whether it's Honda and Nissan discussing a merger, a 9 trillion yen buyout of Seven & I, or the country's life insurers hoovering up assets in the US, animal spirits are alive and well in the country that is facing unfavourable demographics. But what is ultimately driving this wave of M&A? And what do the deals say about the country's wider plan to improve corporate governance? This and more is the focus of this week's Viewsroom. Welcome back to the Viewsroom, the weekly podcast that invites you, the listener, into a lively debate with Breakingviews columnists. I'm your host, Amy Donlan.
And I'm Jonathan Guilford. Amy, for the past few months, we've seen some pretty interesting activity coming out of Japan. In December, you had Honda and Nissan announcing that they were exploring a merger, and there was already a mammoth buyout offer for 7-Eleven owner Seven & I going on. Japan is really interesting for so many reasons right now. I mean, you have rock bottom interest rates for longer than any other country in the West. And they're also facing an aging population, which creates headaches for companies that are trying to grow sales. I mean, it feels like in a certain way Japan is just like in a totally different part of the cycle demographically and economically than, say, the US or the UK, right?
Yeah, I think that's definitely right. And I think even from reading Breakingviews, I was sitting, in Europe thinking to myself, why are we seeing so many big deals in Japan or Japanese companies interested in other deals? So to answer these questions for us, we have our two Asia experts from Breakingviews. We have Katrina Hamlin, who's been looking at the Honda-Nissan deal, and Hudson Lockett, who oversees the Breakingviews Japan coverage. So Hudson, Katrina, you are very, very welcome.
Good to be here.
So Hudson, as I said, I mean, Japan, I think maybe we should start with an overview, because I think, what's happening with the economy, we talked about demographics, the fact that there's this aging population. And I wondered if you might be able to talk us through just some of the drivers for deals. So are we dealing with like very fragmented markets? What's the situation with real estate? I mean, is this a country that is actually ripe for consolidation?
Well, yeah, I mean, I think this is sort of the payoff for a very long and sort of arduous process that's been brewing at the behest of the Japanese government and the Tokyo Stock Exchange on its behalf, the so-called value push, right? I mean, a lot of what is supporting this is, I guess, the idea that you need to make efficiency gains in order to offset that sort of demographic wall you're facing with such a large aging population. And so the sort of mechanism they've chosen to sort of try and use to that effect is the stock market. They're trying to basically have companies push up their value through actually improving their performance, which is a new thing for many listcos in Tokyo. And I mean, all of this is also being driven by sort of the rate rises by the Bank of Japan, which are sort of being enforced, or not, sorry, which are being supported by rising prices and rising wages, and also rising real estate prices. I think, as you mentioned, like all of this is helping to boost property prices, and that's driving interest in sort of the absurdly large amount of real estate that's held by companies listed in Tokyo.
Got it. And it's interesting because you think of sort of post-70s, 80s Japan as this really mighty export power and also home to a lot of brands that really have just made incredible inroads into markets across the world. Obviously, that caused some anxiety for trading partners back in the day, but now the story has shifted a little bit. The rise of China, we see, especially in the automotive market, where there are so many kind of famed Japanese brands that really kind of dominated global sales. You now have a situation where they're getting pushed out of some of their international markets, where you have kind of weakening fundamentals like at home and abroad. And Katrina, you were looking at the Nissan-Honda deal, or non-deal as it now appears to be. And that one was really interesting because from the outside, you look at all these pressures that are on the market. And I know, obviously, in the US, folks are kind of scrambling around this. But it seems like it might have made sense for these two companies to merge. What actually happened there?
Well, a lot of the things that you mentioned just then are relevant. Nissan in particular has been having a horrible time, and that's partly because of the way the auto market has changed, the rise of Chinese electric vehicle makers who have been taking up a lot of market share in China itself, but also in places like Southeast Asia and Europe, which have been important markets for many of these companies, including Nissan. The other thing that happened is that Nissan had its own crises. Its former chair, Carlos Ghosn, was ousted in 2018, and so they were already struggling a bit even before the rise of the Chinese. And so they are in a position of weakness. Honda, for its part, has quite a strong motorcycle business, which has sort of buoyed the group, but their auto unit is also struggling. And so I think this discussion began probably seeing that, there would be strength in size, economies of scale would have been really helpful. Being able to pool resources to develop batteries and smart cars and so on would have been a positive. I think those were probably the drivers.
We should caveat this, Katrina, right, that we are expecting earnings from Nissan tomorrow. We're recording this on Wednesday, so that would be Thursday that this podcast will come out, and I assume the company will probably say something about this deal.
That's right. And in fact, we're expecting, based on reports that come out in the last week or so, we're expecting them to say that it's not going ahead because Nissan has decided to back out. And, that doesn't negate any of what we said before. There's also reports that suggest they're already scouting for alternative partners. But it's been difficult for them to find the right structure for this deal. And I think difficult for Nissan to accept that, the balance of power is not necessarily in its favor, given everything that it's been through over the last few years.
And Katrina, is there a tension then between, because as you said, you laid out very nicely the problems, I guess, or the challenges these companies are facing. So doing a big merger, cutting out costs, stripping out the overlap, like that would be an obvious thing to do. But is that a problem in Japan? Is that difficult to achieve in Japan? The kind of job cuts, I guess, that you would need to make a deal like that work. Is that part of the problem?
So I think for this group and for this sector, the overcapacity issues they're facing are actually not necessarily so much in Japan. They're in some of these other markets where they're rapidly losing share. So China would be a good example. I don't think that makes it any easier for them to navigate this, unfortunately. But yeah, it's not all about what's happening back at home in Japan for these guys.
Right. And of course, you think about these Titanic brands that Japan has kind of in a global scale, right? Like Nissan, like Honda. And then, of course, you also have a retail favorite here in the United States, 7-Eleven, owned by Seven & I back in Japan, which is a slightly different animal, right? And we have to caveat, obviously, that nothing here is a done deal yet. But this was international pressure kind of coming from a different route, right? Because you had Canada's Alimentation Couche-Tard, which kind of lobbed in an offer for Seven & I. You now have a kind of scramble as a management buyout tries to take shape. You have sort of weird overlapping issues here. And I'm kind of curious, Hudson, how all of these interact. You have the pressure that you were talking about coming from kind of corporate reform and the stock market. You have this kind of countervailing pressure where there is an emergent sort of Japanese industrial policy, which is a bit weird to think about in terms of a retailer. And then you also have sort of other international friends like potentially Apollo Global Management kind of coming in here trying to help prop up the management buyout. Can you sort of like pick apart what's happening there and kind of how that relates to all of these greater forces?
Well, sure. Yeah, I think if you want to look at it in terms of sort of the value push, right? It's got pros and it's got cons. So obviously for existing shareholders, it's going to be very nice indeed if the Ito family that founded the group pulls off the buyout and fins off Couche-Tard. But to help fund the buyout, the family is, I think, reportedly considering a listing for the North American assets, so 7-Eleven, as it's so well known. And that would raise, I think, about 1 trillion yen out of the 9 trillion that they are scrambling to put together. And about 6 trillion of that is, I think, going to come from debt. And so the trick of it is that prior to Couche-Tard's approach, the only planned IPO from the 7 & I management was for the group's superstores in Japan. And that indicates that listing this U.S. business is mainly a response to the takeover bid instead of an actual strategic move with long-term benefits for the group. And I think that one thing that sort of folks are keeping an eye on is that really I think both Japan's government and the exchange as well would like to see a value push that is also sort of focused on long-term performance and corporate health and not just short-term returns.
I was sort of curious as well, Hudson, because I don't think this is a new thing, a new phenomenon of Japanese companies going abroad and looking for assets, right? We've kind of seen that for quite a few years. And I think the history is that they tend to overpay. And there's a lot of criticism then that kind of comes after that. I mean, we're seeing a lot of companies are trying to go to the US. There is, I would imagine, going to be a lot of interest there. Will that sort of be a problem then for the sort of Japanese companies that might be trying to, again, go abroad to solve some of the demographic issues that they're dealing with at home? Is there a risk that they end up overpaying again?
Oh, I mean, I think that's definitely a pretty substantial risk, especially right now with markets where they are. I mean, that said, though, I think last year, Japanese corporates announced about 42 billion of U.S. acquisitions just in the U.S., which is more than any other country, and I think there's every reason to expect them to continue to do that this year, especially now that Ishiba, the prime minister, just promised Trump that the flows would keep coming, sort of during their most recent summit at the White House. And so I think that combined with the sort of the demographic pressure and the lack of growth in their home market sort of guarantees that we're gonna see a pretty steady flow of these deals this year, even if they do end up overpaying.
Right, and I kind of wonder if that implies that the reverse is going to be the case, right? Like I sort of mentioned the interest among buyout shops like Apollo and maybe standing behind the 7 & I bid. You have certainly U.S. private equity firms kind of making like a big push into Japan. I think KKR and Bain really are a couple of the big ones there, right? There's a bidding war over Fujisoft. But like the interesting part to me is that it seems like they're always sort of positioning themselves as, I guess, like friends to domestic Japanese causes. And I kind of wonder if that can maybe light a fire under a refocus around Japanese firms buying Japanese firms or Japanese management teams buying out Japanese firms. Like, if there is some kind of friction around like trying to find deals that work, like with Nissan Honda, is there any way that could be pushed either by kind of buyout money from abroad or just like the more general corporate reform landscape?
Well, I think one thing that is sort of fostering sort of much more interest even among domestic buyout funds is just the unwinding of these cross shareholdings that have been sort of held by different companies and different listed companies for such a long time. And that is, I guess, finally coming undone. And that is not only enabling sort of funds or activist investors and PEs to actually start making approaches on these companies, although they're always, so far at least, they've always been very polite. It is also sort of allowing activist investors to put much more pressure on them by sort of picking up those stakes. I mean, actually, earlier we were mentioning, I think, the real estate holdings of all these companies. And I think that, like, I want to say the total value there is, I think, around 25 trillion yen across the entire Tokyo market. So that's like 170 billion dollars, and it's pretty much all over the place across all sectors. And the reason that it's sort of not been taken advantage of yet is because when all of these companies were buying land, they I guess they recorded at book value, and it's still sitting on the books thanks to sort of a Japanese accounting quirk. It's still sitting on their books at that level, even though the value of land in Tokyo shot through the roof. And so now you've got folks like Elliott, I think late last year, picking up a 5% stake in Tokyo Gas because it thinks the company has a real estate portfolio that's worth $1.5 trillion yen, which is as much as the company's equity value, actually. And so I think that these are not sitting on its own. Tokyo Gas would never have done anything about that, frankly, right? And that is a lot of value to unlock. And I think that generally speaking, so long as you, I mean, we'll see. Maybe somebody will go like truly hostile at some point. But I think as long as you take a more polite approach than many foreign firms did in the early 2000s, when they were kind of perceived as barbarians at the gate, so to speak, you've got a pretty good chance of not only sort of getting a warm welcome from investors, but also sort of looking pretty good to boot.
Got it. So a polite push from overseas
Yes.
could help push Japanese domestic M&A.
Kindly nudge.
Right. Okay, great. Well, this has been fascinating. Obviously, sounds like we're going to be hearing a lot more about this in the very near future. But for now, Katrina, Hudson, thank you so much for joining us on the Viewsroom.
Pleasure to be here.
Thank you.
Thank you.